Broadcom just posted the best AI chip quarter in its history, and the stock fell. That gap between result and reaction is the entire story of where Broadcom sits right now. In Q2 FY 2026, Broadcom's AI semiconductor revenue came in at $10.8 billion. That is a 143% increase year over year. It beat the company's own forecast of $10.7 billion. Huang disclosed a sixth hyperscaler XPU customer, OpenAI, targeting 1 gigawatt of compute by 2027. Anthropic is planning 3 gigawatts on the same timeline. By any headline measure, this was a record-breaking, thesis-confirming quarter. Shares fell roughly 3% in after-hours trading. That reaction is not irrational noise. It is a coherent signal, one that requires unpacking two things the headline number conceals. First, total revenue missed expectations. Not AI chip revenue, total revenue. The difference lives in one segment, the infrastructure software unit that houses VMware. That segment delivered $6.5 billion against analyst estimates of $6.8 billion, a 4% shortfall. For a stock trading at approximately 35 times forward earnings, a miss anywhere in the model is punished immediately. The market does not grade on a curve when the valuation already prices perfection. Second, the miss was not random. It traces back to a specific structural decision Broadcom made when it acquired VMware for $61 billion. The company built a dual-track business, custom AI chips for hyperscalers, plus enterprise software at cloud scale. Both tracks were supposed to be additive. The Q2 result is the first concrete evidence that they may not be. This is where the standing read on Broadcom starts to crack. The consensus treated AVGO as an AI chip story that happened to have software attached. The Q2 miss forces a different question. Is this a software integration story that also happens to have AI chips? The answer changes the multiple, it changes the risk frame, and it changes what holders need to do next.
Here is the hidden assumption the Broadcom bull case requires, and that almost no one states explicitly. To justify the current valuation, Broadcom needs Huang to simultaneously run the largest custom AI chip business in the world and complete the operational integration of a $61 billion software acquisition, and sustain VMware's enterprise renewal base, and ramp new cloud marketplace distribution channels, all without execution bandwidth constraints. That is not a standard ask. That is a compounding operational bet. The VMware $300 million shortfall against expectations is small in absolute terms. At Broadcom's scale, $300 million is less than 2% of total quarterly revenue, but the signal it carries is disproportionate to its size. It tells the market that VMware's growth trajectory, the one that justified the $61 billion acquisition price, is not running on the schedule the bull case assumed. There is a second layer. When Broadcom announced an expanded collaboration with Google Cloud in April 2026, the partnership was not about chips, it was about VMware. Broadcom is now distributing its software-defined infrastructure through Google's cloud marketplace, essentially using Google's Salesforce to sell VMware licenses at scale. That looks like channel innovation, but consider what it implies structurally. Cloud marketplace deals involve a revenue share with the platform. Google Cloud takes a cut of every VMware sale that runs through its channel. The net revenue per seat that flows back to Broadcom is lower than what direct enterprise renewal generates. If VMware's growth is increasingly dependent on cloud marketplace distribution rather than direct enterprise contract renewal, the margin profile of the software segment is structurally different from what the original acquisition thesis assumed. The Q3 guidance makes this tension explicit. Broadcom guided for total revenue of approximately $15.8 billion next quarter. That number requires AI chip revenue to sustain above $1.1 billion, a sequential increase from the $1.08 billion record just posted, while VMware simultaneously returns to growth. Both conditions must hold at the same time. Q3 earnings will be the first clean test of whether Broadcom can run both tracks in parallel or whether management bandwidth has a ceiling.
The bull case for Broadcom's AI chip business rests on a pipeline that Huang described in specific terms on the Q2 call. OpenAI is the sixth hyperscaler customer, targeting 1 gigawatt of compute capacity using Broadcom's custom XPU chips by 2027. Anthropic is targeting 3 gigawatts on the same timeline. The existing customers, Google, Meta, Apple, and one undisclosed hyperscaler, are already in deployment. The gigawatt framing is important.
1 gigawatt of AI compute is not a product order, it is a multi-year infrastructure commitment. A customer signing on for a gigawatt of XPU capacity is making a decision that will define their AI infrastructure stack through the end of this decade. Winning that commitment is strategically durable in a way that a chip order cycle is not. That is the legitimate bull case, and it is substantial. But there is a number embedded in Huang 2027 timeline that the market is currently treating as given: 18 months. The distance between today and the deployment targets Tan described is approximately 18 months. Historically, hyperscaler capital plans at this scale, multi-gigawatt, multi-customer, custom silicon, slip by 6 to 12 months. Not because the commitment weakens, but because chip design iteration cycles, fab capacity allocation, packaging yield, and data center power procurement each carry their own timeline risk. If the XPU ramp from OpenAI and Anthropic slips by even 1 or 2 quarters, the revenue recognition timeline for the AI chip segment shifts, and the Q3 and Q4 results, the 2 quarters between now and calendar year end, will be the first observable data points on whether the 2027 ramp is tracking. The market has not priced that slip risk into the current multiple. At 35 times forward earnings, AVGO is priced for the XPU timeline to hold exactly as described. Any revision to that timeline, even a minor one, introduces a gap between the multiple and the delivery schedule that will need to close somehow. This is why the Q2 after-hours reaction, while counterintuitive on the surface, carries analytical logic. The record AI chip quarter confirmed the demand side, it did not confirm the execution timeline. Huang also disclosed that Broadcom's AI backlog surged to $30 billion in the quarter. Visibility now extends into 2028. That backlog is real demand, it is not speculative. But backlog is a commitment, not delivered revenue. The conversion rate from backlog to recognized revenue is the variable that matters for the multiple, and it depends entirely on the execution timeline holding.
The standing read on Broadcom, that it is the cleaner AI chip pure play compared to NVIDIA, because it derives revenue from locked-in hyperscaler custom silicon rather than GPU cycles, was coherent before Q2. After Q2, that read requires an addition. Broadcom is no longer just a custom chip story. It is a dual revenue dependency story. The AI chip business needs to keep growing above $11 billion per quarter. The VMware software business needs to return to growth while navigating a channel transition toward cloud marketplace distribution at lower net margins. Both conditions must hold simultaneously, at a 35x multiple that gives the company no room for sequential misses. The leaning here is asymmetric, but not in the direction most headlines suggest. The AI chip business is structurally strong. 6 hyperscaler XPU customers with gigawatt-scale commitments is a defensible moat. The 143% year-over-year growth rate is not a statistical artifact. It reflects the secular shift by hyperscalers toward custom silicon over general-purpose GPUs. That shift does not reverse on a quarterly miss. But the VMware integration is now the variable that determines whether Broadcom deserves its current multiple or whether it should trade closer to a blended multiple that reflects 2 businesses with different risk profiles. A holder of AVGO today is not betting only on AI chips. They are betting on Huang's ability to execute 2 parallel transformations, one in semiconductors, one in enterprise software, without one drawing bandwidth from the other. The Q2 result is the first data point suggesting that the second transformation may be harder, slower, and lower margin than the bull case assumed. The forward checkpoint is Q3 FY 2026 earnings. The specific numbers to watch: AI chip revenue relative to $11 billion and VMware segment revenue relative to $6.8 billion. If both recover simultaneously, the standing read holds. If VMware misses again while chips grow, the dual-track concern crystallizes into a structural discount. If chips miss while VMware recovers, a different conversation begins. That Q3 result is the moment when the market will either confirm that the paradox quarter was noise or confirm that it was the first signal of a more complex execution story than the current multiple has priced. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.